Okay, so you want to own a shopping mall. Here's the number that decides whether that works, and it's the opposite of what you'd guess. In a typical anchored shopping center, the biggest tenant in the building, the one everybody actually comes for, occupies around 3/4 of the floor space and pays under half the rent. That's not a negotiating failure, that's the design. Picture a neighborhood center with 60,000 square feet of leasable space. The grocery anchor takes 45,000 of it and pays around $10 a square foot. The 15,000 square feet of small shops along the front pay 35. The anchor has 3/4 of the building and contributes less than half the income. The landlord runs that math deliberately. The cheap anchor rent is not a discount, it's a purchase. What you're buying is footfall, and the reason it's worth buying is that an anchor tenant pulls roughly 5 times more visitors than an average store in the same center. Every one of those visitors walks past the small shops on the way in and on the way out. So the anchor is not really a tenant, the anchor is the product, and the small shops are the customers. They're buying access to a crowd that somebody else assembled. Which is an elegant machine, right up until the moment it isn't. Because the small tenants know exactly how dependent they are, so they negotiate protection, a clause that says if the anchor closes, or occupancy drops below a threshold, their rent falls or they can walk. It's called a co-tenancy clause, and it's in a large share of inline leases. Which means when an anchor leaves a mall, the landlord doesn't lose one tenant. The landlord loses one tenant, and then the leases start firing on their own. Nobody has to make a decision. The contracts do it. That's why a mall can go from full to failing in about 3 years. And it's why, of the roughly 25,000 malls this country had in 1986, somewhere around 1,200 are left. Let's start with what a mall actually sells. Because it isn't shopping. A shopping mall does not sell anything to a shopper. It has no inventory, no tills, no customers in the retail sense. It sells square feet and footfall, and its customers are the retailers. There are 4 broad formats, and they're different businesses. The neighborhood center, grocery anchored, usually 30 to 150,000 square feet, serving a couple of miles. This is the most resilient format in American retail, because people buy food weekly in person regardless of what happens online. The community center and power center, larger, anchored by big box retailers rather than a grocer, often unenclosed. These live or die on the health of a small number of very large tenants. The regional and super-regional mall, the enclosed thing you picture. Anchored by 2 to 4 department stores, with anywhere from 400,000 to over 1 million square feet of leasable space, and 100-odd inline tenants along the corridors. This is the format under the most pressure, and the one this video is mostly about. The outlet and lifestyle center, newer, usually open air, built around destination and experience rather than convenience. Nationally, there are around 116,000 shopping centers in the United States, by the industry's own count, but only about 1,200 enclosed malls. That distinction matters, because the headlines about retail dying are mostly about that second, much smaller number. And there is one structural fact worth planting now, because everything later depends on it. No new enclosed megamall has been built in the United States since 2019. In a country that adds population every year, the enclosed mall stopped being something anyone builds. That tells you what the market thinks about the format's economics. But it doesn't tell you why. For that, you have to look at the lease. Because the whole business is in the lease. Start with the anchor. Anchor tenants in American shopping centers typically pay somewhere between $8 and $15 per square foot in base rent. Inline tenants, the smaller shops, typically pay $25 to $60, and in strong malls considerably more. So the rent per square foot differs by a factor of 3, 4, sometimes more, inside the same building, under the same roof, with the same air conditioning. And the anchor gets more than a low rate. Anchor leases run 10 to 25 years, sometimes 30, against 7 to 10 for inline tenants. They come with tenant improvement allowances. They come with approval rights over what the landlord can lease nearby. And in a great many cases, the department store owns its own box outright, meaning it pays the landlord nothing at all and cannot be removed. Sit with that. In a lot of American malls, the single largest structure on the property generates 0 rent for the owner. Why would anyone agree to this? Because of that 5 times footfall number. An anchor at 1/10 of the inline rate still delivers 5 times the visitors, which means its effective rent per visitor is enormously more efficient for the landlord than an inline unit's. The anchor is not paying for space. The anchor is being paid, in space, to bring people. And it works. That's the important part. This isn't a con that somebody fell for. It's a bargain that made both sides money for about 50 years. The department store got a cheap, enormous box in a location it didn't have to develop. The landlord got a crowd it could sell access to at $35 a foot. But look at what it does to the risk profile. The landlord's income is concentrated in the tenants with the least floor space, the shortest leases, the thinnest margins, and the highest failure rate. The stable, long lease, investment-grade tenant is the one contributing the least. Your revenue sits on the fragile end of the building. Your traffic sits on the end you can't charge. That's the cross-subsidy. Now here's what it costs the tenant on the paying end. If you lease a small shop in a mall, base rent is the beginning of the conversation, not the end. First, CAM, common area maintenance, your pro rata share of cleaning the corridors, running the heating, staffing security, lighting the car park, maintaining the roof. In shopping centers, CAM commonly runs $5 to $12 per square foot per year, billed on top of rent. And crucially, the anchor's CAM contribution is usually capped at a token rate, sometimes as low as $2, negotiated decades ago. So the small tenants pay to air condition a building whose largest occupant contributes almost nothing to the bill. Second, taxes and insurance, also passed through pro rata, also on top. Third, the marketing fund, a levy, often a percentage of rent, that pays for the mall's advertising and seasonal events. You are contractually required to fund the promotion of the property you rent from. Fourth, percentage rent. This is the one that surprises people. Most mall leases now use a natural breakpoint. You pay base rent, and once your sales cross a threshold, you also pay the landlord a percentage of everything above it, typically 5 to 8% of gross sales. Meaning, if the store does well, the landlord's income rises automatically. Your success is written into their revenue line. Add it together, and the industry's own rule of thumb is that total occupancy cost should stay between 6 and 10% of sales. Above that, the store is in trouble. And the tenant funds the fit-out before any of this starts. National average build-out running around $149 per square foot, and well over $200 in the most expensive markets. So the inline tenant is paying rent, plus the building's running costs, plus the building's marketing, plus a slice of their own upside, on a 7-year lease, in a box they paid to build. They accept it for exactly one reason, the traffic. The whole arrangement is priced against a crowd that the anchor delivers. Which raises the obvious question, what happens to those numbers when the anchor stops delivering it? The answer is already in the contract. Inline tenants are not naive. They know their rent is priced on somebody else's footfall, and they negotiate accordingly. The instrument is the co-tenancy clause. In plain terms, my rent obligation is conditional on you keeping this place full. They come in two flavors. Opening co-tenancy says I don't have to open until named anchors are trading. Ongoing co-tenancy says that if a named anchor goes dark, or if total occupancy falls below a threshold, commonly 70 to 80%, then my remedy kicks in. That remedy is usually one of three things. My rent drops to a reduced figure, or I switch to paying a percentage of sales instead of base rent, which in a struggling mall is dramatically less. Or, after a cure period, I can terminate and leave. Now run the sequence. An anchor closes. Say it was paying $10 a square foot on 100,000 feet. $1 million of annual rent, gone. Painful, but survivable on its own. Except the co-tenancy clauses now trigger across the inline leases. A meaningful share of your paying tenants, the $35 a foot tenants, the ones carrying the building, drop to reduced rent or convert to a percentage of sales deal. At the same time, the traffic that anchor generated disappears, so the sales-based percentage rent across the whole mall falls with it, and the anchor's CAM contribution vanishes, so the landlord now absorbs a share of the operating costs that a tenant used to cover. Which means one anchor departure worth $1 million in rent can comfortably cost 2 to 3 times that in total income once the clauses have finished working. And then the second-order effect. A mall visibly emptying is harder to lease. Prospective tenants price the risk. Existing ones don't renew. Occupancy slips further, tripping more thresholds. This is what people are describing when they say a mall died. It usually wasn't a slow fade. It was a contractual cascade that a single closure set off, running on terms everyone signed years earlier. Once 2 anchors go, the property tips. Here's the part the malls are dead story gets wrong. Malls are not failing uniformly. They're diverging, and the split is measurable. The industry sorts malls into classes by sales per square foot. Class A malls do $500 or more per square foot. Class B do $300 to $500. Class C do under $300. At the start of 2026, mall vacancy nationally sat at about 8.8%, roughly double the vacancy rate of American retail property overall. But that average hides everything. Class A malls were running around 5.6% vacancy. Class B around 9%. Class C 13.3%, more than double the Class A figure. And at the top of the market, the numbers are frankly good. Simon Property Group finished 2025 at 96.4% occupancy across its malls and outlets, with average base rents up 4.7% year over year. That is not a distressed asset class. That's a landlord with pricing power. Meanwhile, the bottom of the market is being dismantled. 2.6 million square feet of mall space was demolished in 2025. Roughly 300 more malls are projected to close by 2028, taking the national count from about 1,200 down toward 900. So the honest description isn't decline, it's concentration. The A malls are absorbing the retailers, the traffic, and the rent growth. The C malls are being taken apart. And the mechanism is the one we just described. A Class A mall has anchors people still want and occupancy comfortably above every co-tenancy threshold in the building. A Class C mall has one dark box, a second one wobbling, and a rent roll where half the leases have already converted to reduced terms. Same format, same lease structure, opposite direction, because the cascade only runs one way. Let's put an actual year together. This is an illustrative model built on sector averages, not a real property. Take a mid-tier regional mall, 600,000 square feet of leasable space. Anchors, 3 of them, 300,000 square feet combined, at $10 a foot, $3 million. Inline, 250,000 square feet at $35, $8.75 million. So the anchors hold half the building and produce about a quarter of the base rent. There it is again. Add percentage rent, kiosks, and specialty leasing. Call it another million. Gross rental income lands near $12.75 million. Now the costs. Running a 600,000 square foot enclosed building. Security, cleaning, heating and cooling, insurance, property tax, management, marketing, comes to roughly $8 a foot. Call it $4.8 million. Most of that is recoverable through CAM, but not all of it. The anchor's capped contributions and any vacant space leave the landlord carrying a shortfall, say $1.2 million unrecovered. Add corporate overhead and leasing costs of about $1 million. That leaves net operating income around $10.5 million, which then has to service the debt on a property that might carry a $100 million loan. Workable, not spectacular, real. Now lose one anchor. The direct hit is that anchor's $1 million in rent. Co-tenancy clauses trigger across a portion of the inline roll. Say a third of it converts to reduced terms, costing another $1.5 million. Traffic drops, so percentage rent falls by $400,000. And the anchor's CAM contribution disappears, adding $200,000 to what the landlord absorbs. One tenant leaves. $3.1 million of income leaves with it. The building looks identical. Same square footage, same corridors, same lights on. The only thing that changed is that a clause fired. That's the whole business in one number. Which brings us to what a failing mall actually is. A regional mall sits on a lot of land, commonly 50 to 100 acres, sometimes more, in a location that was chosen decades ago precisely because it had highway access, utilities, parking, and a catchment full of people. Everything a developer wants. And when the retail arithmetic stops working, that's what's left. The market prices this fairly bluntly. The average vacant mall sells for around 43% below its previous acquisition price. The retail income is gone. What the buyer is paying for is the site. Then it gets converted, and overwhelmingly, into one thing. A JLL study found that around 54% of mall redevelopments incorporated residential, and roughly a third of redeveloped anchor boxes, most often former Sears stores, were replaced with housing. 2 live examples. Westminster Mall in Orange County, California. Its last anchor closed in November 2025. A developer consolidated the site to 83 acres and is replacing it with roughly 2,250 homes, a 120-room hotel, and around 220,000 square feet of new retail. Demolition began in 2026. Notably, one anchor is staying, a Target, which owns its position and still works. Hawthorne Plaza in Los Angeles County. A 35-acre mall that closed in the late 1990s and simply sat there for a quarter of a century, through multiple failed redevelopment plans, until the city obtained a court injunction requiring the owner to redevelop or demolish it by August 2026. That second one is the more honest picture of how this ends. Not a clean pivot to housing, a decade of nothing, because assembling the site, rezoning it, and financing the demolition is slow and expensive, and the owner has no obligation to hurry. So the mall becomes a landholding with a very large depreciating building on it, and the building is not an asset in that transaction, it's a cost. So if you do buy one, here's what you're actually buying. You're buying a machine that converts footfall into rent, and you don't own the thing that generates the footfall. Your biggest tenant produces your traffic and pays you the least for the privilege, sometimes nothing, because it owns its own building. Your income comes from small operators on short leases, and every one of those leases contains a clause that reduces what they owe you if the property gets emptier, which makes this a business with a very specific shape. On the way up, it compounds beautifully. Traffic supports rent, rent supports reinvestment, reinvestment supports traffic. Class A malls are still doing exactly that, at 96% occupancy with rents rising. On the way down, it compounds just as efficiently in reverse, and faster because the contracts accelerate it. One closure triggers clauses that trigger vacancies that trigger more clauses. There is no stable middle. That's why the class data looks the way it does. The A's getting stronger, the C's being demolished, and the B's having to pick a direction. The mall was never really a shopping business. It was a traffic business that charged rent for proximity to a crowd. And when the crowd goes, the leases don't wait for anyone to decide what happens next.